People have been awaiting a recession for quite some time. Granted, the S&P 500 has traditionally peaked 14 months before the start of a recession.
Okay, so first of all, hi Sam, nice to have you conversation with you. It's a pleasure to have someone like you, and so I really appreciate your willingness to talk to me.
My pleasure, Hector. Thank you for inviting me.
As I said before, it's a pleasure to me. So I want to ask you first of all, I want to focus the conversation on your experience, and then we will talk about your the current events of the economy and the stock markets. So how did you come to work in the world of the stock markets?
Well, actually, it ran in the family. My father started working on Wall Street in 1953, and actually, his father before him was one of the first employees of Reynolds and Company that later became Dean Witter Reynolds. So Wall Street has been in our family since the early 1930s. Also, my first job on Wall Street was working in the mailroom of Reynolds and Company in the early 1970s. But in terms of real employment, it was at Argus Research, an independent equity research firm in New York City, and that was in the mid-1980s, before switching over to Standard & Poor's, where I was for more than 27 years. My last job at Standard & Poor's was the chief investment strategist, and now I've been at CFRA since 2016 because Standard & Poor's sold its equity research division to CFRA, getting out of the business that it started back in 1860. There really was an analyst named Henry Varnum Poor who wrote research reports on railroads.
How do you remember the first days in Wall Street? I think, I mean, some things changed than if you focus on the current Wall Street. Some things changed. How was the first days in Wall Street for you, and how has changed from now?
Well, certainly back in the early days, from a capturing of stock price information, you pretty much had to do that by hand, whether you were a fundamental analyst looking at prices, looking at earnings, et cetera, or you were a technical analyst doing hand-drawn point and figure charts. That's basically how things were done in the 1970s and 80s. Research reports were essentially typed on a typewriter, and you used either carbon paper for mimeographs, or you then gave it to somebody who typed it into a professional publishing system that then produced the newsletters that were then distributed to clients. So before the personal computer, a lot of things were done by hand. When we got the first computer, I just was amazed as to how liberating it was to be able to copy, paste, cut, delete, etc. There was no holding you back in terms of creativity with your writing.
Mm-hmm. What is your best investment strategy that you remember in your entire career?
Well, probably the best strategy that I remember is the old Wall Street sayings. I wrote a book back in 2009 called The 7 Rules of Wall Street, which are rules-based sector rotation strategies. And you've heard of some of those words, like let your winners ride, but cut your losers short. Shows that momentum tends to be the best way, that you want to be gravitating toward companies with high momentum, not low momentum. Also, taking a look at sell in May and go away. I basically tell investors, don't retreat, don't go away, but rotate, gravitate toward those sectors that do the best in the challenging May through October period, and then stick with the more cyclical sectors November through April. So use seasonality along with momentum. And as a result, pacer picked up this concept and created an ETF based on this strategy. The ticker is SZNE, and it's a seasonal rotation strategy. And then finally, correlation. Someone used to say there's no free lunch on Wall Street, but actually, if you invest with an eye toward correlation, you can get a higher return with lower risk. Specifically, a portfolio of 50% technology, 50% consumer staples, rebalanced annually since 1990, actually outperformed technology, which was the best performing sector over that time period, and did so with substantially lower volatility. So seasonality, momentum, correlation, those are the best strategies that I have embraced, while at the same time extracting my emotions from the equation, because for many investors, your emotions can become your portfolio's worst enemy.
Great. Also, I want to ask you about the best day you remember and the worst day working in stock markets, maybe mainly in Wall Street. I mean, you've seen everything from the dot-com bubble, the tech rally, to the 9/11, to the Lehman Brothers bankruptcy. What are the days, the best day and the worst day that you remember operating in the markets?
Well, I guess best days are usually defined as up days, and the worst days are the down days. And I do remember the summer of 2011 when Standard & Poor's downgraded the U.S. debt. So that was certainly a challenge. I remember doing an interview where somebody said to me, well, why should we be listening to you? You work for Standard & Poor's, and they were the ones that created the financial crisis. And really? I said, well, you'll have to remember that I'm on the equity side, not the debt rating side. And as a result, if you are upset with the IRS, don't blame the Fed. So got to make sure that you understand which side of the coin you are looking at. In terms of best days, well, certainly sticking with stocks over bailing out. I am reminded quite frequently how quickly the stock market gets back to break even after a fairly significant sell-off. Interesting, but whenever the market has fallen by 5 to 10%, it has traditionally gotten back to break even in only a month and a half. For declines of 10 to 20%, it's only taken 4 months. And after bear markets, the traditional turnaround time is about 14 months. So what always just amazes me is the speed with which investors decide to get back into what otherwise was a bear market.
Yeah, that's true. Since I mentioned Lehman Brothers earlier, this year is precisely the 15th anniversary of the bankruptcy of the bank. How do you remember that moment, the Lehman Brothers stuff? How do you remember that?
Well, during the 2007 through 09 bear market, in which the S&P lost nearly 60%, at first, when Bear Stearns went under, expectations were that, gee, maybe that's the worst of this decline, because like Drexel Burnham, like Continental Illinois, many of these individual companies that go out, they tend to signal the end of the bear market. Well, no, the Bear Stearns collapse was really just the beginning of the bear market. So when I was looking at Lehman, really my heart was going out to those employees who were videotaped leaving the building, carrying nothing but a box of their personal possessions, and just realizing that they are going through very challenging times. Essentially, you try to empathize with people who could be in a similar position with you.
And do you think the financial industry has fixed the problem that were there at that time, or are there some cracks or system failures right now?
Well, I think that, it's almost like armies always fight the last war. And in terms of fixing errors of the last bear market, I don't think we're going to get caught by what was the problem in 2007 through 09. We're not experiencing a tech bubble as we did in 2000 through 2002. Remember, back then, investors thought that technology stocks trading at 60 times forward 12-month earnings were a bargain. Well, we're not experiencing that now. So whatever mistakes we make will probably end up being new mistakes. But the problem also is that they tend to occur with a lot of time in between. So people tend to forget what it was like back in the prior mega meltdown or bear market in excess of 40%.
What kind of new mistakes you said? What kinds of new mistakes do you think we are facing with?
Well, people like to say that bear markets occur because of unanticipated events. And as a result, I find unanticipated events hard to anticipate. So I can't tell you what are going to be the new problems. Possibly an area we've already seen a very large decline in the cryptocurrency space, in Bitcoin, et cetera. Primarily because how do you value something like that? It's not that they have an earnings stream or a cash flow stream that you can use an intrinsic value model on. So it's really based upon what the most recent sale price happens to be. So maybe you can look at it from a technical perspective, but certainly not from a fundamental perspective. We've also seen how housing has gotten so expensive. Maybe we have more challenges with housing as we move forward, as the Fed continues to raise rates and keeps them higher for longer. Traditionally, since 1947, when the government started capturing CPI, Consumer Price Index data, whenever we have seen the CPI in excess of 6%, we have had a recession accompanied by a bear market. And on average, that bear market fell 35%, occurring over a 15-month period. Well, if this bear market was over on October 12th, we were only down 25%, and it lasted only 9 months. So, yeah, maybe the bear market did end back then, because at least 3 other bear markets with recessions also ended after falling only in the middle 20% area. So until we get back to break even, I think investors have to realize that there could be more challenging times ahead.
Related with that, with as you said before, I want to ask you about if you think the operating in stock markets are more challenging than before because of there are more retailers, investors than before. Do you think it's more challenging this kind of more retailer investors than before, than institutional investors?
Well, I think every investor has to realize that there are more and more competitors out there. I jokingly say that investors are no better than hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to when the music will start or stop. So I think that investors who think that they can outrun the professionals are really just setting themselves up for disappointment. I'm frequently asked if I think that investing is just another form of gambling. And I say, well, if it is gambling, I would like to know what casino pays the gambler 80% of the time, because with dividends reinvested, the S&P 500 has risen about 80% of the time, 80% of the years going back to World War II. So long-term investors, I think that if they simply diversify and stay the course, they will benefit from investing the way they expected. But if they try to take a very short-term trading kind of an approach, I think they are setting themselves up for disappointment.
Talking about the current events, the focus now is on raising interest rates that you said before, and to cope with the inflation. Where do you think the terminal rate for interest rates by the Fed is?
Our expectation is that the Fed will stop raising rates after the June FOMC meeting. So we think that there will be 25 basis point increases at the March, May, and June meetings. That'll bring the terminal rate up to 5.375%. And then I think that the Fed will pause. The real question is, how long will they pause? Because historically, the Fed starts to cut interest rates an average of 9 months after the last rate increase. So that would put us into early 2024. when the Fed would start to consider lowering rates. But they've warned us time and time again that they are not going to make the same mistakes that the Fed did in the 1970s. They're not going to stop rate tightening and easing cycles, only to, in a sense, fan the flames of inflation. So I would tend to say that while they might stop at the 5.375 level, maybe they won't start to cut interest rates until deeper into 2024.
One of the debates is to move the Fed's inflation target above 2%. Do you see this happening? Maybe 3% or something like that? It's one of the debates that more economists have right now. What's your point with this?
Well, since we believe that the year-on-year percent change in core PCE will be 3.3% at the end of this year, there's certainly a possibility that the Fed will end its rate tightening program before hitting its 2% target. But let's face it, the Fed is aiming at a target that's below the horizon. So it wants to make sure that it doesn't overshoot, does not tighten too aggressively, that throws the U.S. economy into another Great Depression. So while the Fed might stop raising interest rates, they're going to take their time in terms of when to start to cut interest rates, because they realize that it takes a good 12 months before the economy responds to a particular rate change. So I would tend to say that the Fed probably won't be starting to cut interest rates maybe until the summer of 2024, but they could certainly end their rate tightening program well before that.
So another topic on the street is the entry into recession in the United States. There are leading indicators such as the inversion of the yield curve, leading indicator conference board, the situation of the real estate market. Do you think there will be a hard landing for the U.S. economy, or soft landing or no landing? What's your point here?
Well, that's the $64,000 question, to borrow a TV show title from the late 1950s. People have been awaiting a recession for quite some time. Granted, the S&P 500 has traditionally peaked 14 months before the start of a recession. And what we've also found is that recessions tend to be coincident with earnings recessions. And we believe that the earnings recession probably started in the fourth quarter of last year. And that's because we expect to see a near 4% decline in earnings for the S&P 500 through the fourth quarter of 2022. We expect to see 5+% declines in each of the first two quarters of 2023. So I think we're going to have to wait to find out from the National Bureau of Economic Research, the NBER, when exactly the recession did start. Now, unfortunately, they're not the quickest to let us know that. Traditionally, they have waited about 8 to 9 months before telling us that the speed bump we hit 9 months ago was the beginning of a recession. So investors have to be patient, but also realize that by the time the NBER does tell us that we're in recession is usually the best time to start buying stocks once again.
Do you think the more or the later recession occurs is worse for economy? I know. I mean, if the recession starts later, maybe it would be worse, right?
Well, that's a good question, because I've been thinking about that. Let's think about some fairly quick recessions. In 1990, you had the recession and the bear market essentially start at the same time, and that was July of 1990. The bear market ended in December of 1990. The recession also was fairly quick, fairly mild. We also look to 2020, where we were told that the recession occurred very swiftly. The NBER told us in June that the recession had already started, but that ended up being a fairly sharp decline in the overall stock market, and it was also a fairly deep recession. But because it was a pandemic-induced recession, not an economically induced recession, we were surprised as to how quickly the market fell. It declined 34% in only 33 trading days, which was the fastest on record. And we also got back to break even in fewer than 5 months, which was the third fastest on record. Now, if we say, well, let's take a look at 2000 through 2002, we were in a bear market starting on March 24th of 2000 for the S&P 500. Similar for the NASDAQ, but January of 2000 for the Dow. We didn't fall into recession until March of 2001. So a good year later for the S&P, year and a quarter later for the Dow. And that did end up being a fairly mild recession, but a very, very deep bear market, off 48%. So I think that, we have to say that it really all depends. The Great Depression, or I should say the Great Recession, occurred in 2008, the financial crisis. But because of the actions of the Fed and the Treasury in terms of flooding the market with currency, allowed us to be able to recover fairly quickly and continue to move higher since then.
Mm-hmm. Yeah, I think the scenario, it looked like some weird right now with in comparison with other bear markets or situations than this year. But just
you could
few.
You could look, Hector, at
Yeah.
1973-74, because back then we did have high inflation, we did have high energy prices. And so maybe that is the bear market and recession we should be comparing with. Again, a near 50% decline in the S&P 500, and also a very deep and lengthy recession. So possibly the Fed has a lengthy fight on its hand as it tries to battle inflation.
Yeah. In these times, Fed caused a double recession in the ends of the 80s, and then in the beginnings, in the earliest of 80s. And I think Powell maybe want to avoid this scenario, but we have more debt than these years, and it's difficult because the new emissions are are higher interests. So it's difficult for some companies, zombies companies, What's your opinion about that? About how these interest rates higher for some companies that depends on his new debt, new emissions of that to survive?
Sure. Well, whether it's an individual, a company, or a government, the more debt they have in a rising interest rate environment, the greater the challenge is for them to pay off that debt. I mean, that was actually the conclusion of why the recession and bear market of the 1930s was so severe, was because of all of the debt that companies had on their books. So when we think about the U.S. government, we think about its debt. And we think about the debt that we're continuing to pile on, and it has to pay it off based on the higher interest rates. The only good thing is that the U.S. government can print the money that it needs to pay that debt. The only problem is it causes investors to have reservations about the U.S. currency, which could end up causing our dollar to weaken over time. So it could end up being a double-edged sword, where the government is spending more on debt repayment than it is on defense. So that is a concern that certainly individuals, corporations, and governments will have. What would be better is if the government were selling long bonds rather than shorter bonds and notes, so that it could have a lot more time to pay them off. Also, same with companies. If they have long-term debt that is at a fairly low interest rate, well, they're pretty well protected. But it's those companies that have very short-term debt that they have to roll over at increasingly higher interest rates that could end up being a bigger challenge.
You think if we are going to be in a recession, maybe next coming months or maybe a year, you think QE's policies could come back, or you discard this option from the central bank?
Well, I think that the central bank is going through quantitative tightening right now, in a sense, to build back its own reserves, just as the Fed has engaged in easing monetary policy to challenge recessions and bear markets. It has then gone back to tightening policy in order to slow down the rate of inflation. So the tools of the Fed's trade are not only used once, they are used continuously over time, depending on what the monetary and economic conditions require. So should the Fed decide that it needs to engage in quantitative easing once again in order to spur economic growth, then yes, I will think they will do that.
So just a couple of questions. In your opinion, could the S&P 500 reach new lows, or has the worst already been seen for the index? What's your point?
Well, I believe that because we currently are of the mindset that we are either going to have a soft landing or really no recession because of the strength of employment, we possibly saw the bottom on October 12th. We are currently in a new calendar year following a down year. Since World War II, the market has gained about 9% per year and has risen in price about 70% of the time. Following a down year, the market was up more than 14% and rose in price 80% of the time. And if you then take a look at some of the stock market indicators from the Stock Traders Almanac, like as goes January, so goes the year, the January barometer following a down year has pointed to a positive return in the market of 21%, with a frequency of advance now at 92%. So each one of these indicators has implied a greater full year return and an increased likelihood of a positive return, but none of these indicators should ever be taken as a guarantee.
Okay, just a last one, which is, what assets should we be invested in today in order to avoid the damage of inflation and the scenario discussed above?
Well, I think that over the long haul, equities are still the best asset class because you can benefit from a higher dividend yield and therefore get paid while you wait. But also stocks have tended to outpace inflation over the long haul. Since the late 1940s, the Consumer Price Index has posted an average gain of 3.5%. Ditto for the personal consumption expenditures, the PCE that the Fed prefers. And also whether you're dealing with it on a headline or a core basis, we're still looking at anywhere from 3.5% to at most 4%. But if equities had been gaining almost 9% on average, then after inflation and obviously taxes, you still tend to be ahead of the game with equities, whereas the yield on the 10-year note has averaged about 5.3% going back to the 1950s. So while that still has outpaced inflation, the margin of safety is a lot narrower.
Okay, so thank you very much for that vision. Thank you very much for your time. It has been a pleasure, as I said at the beginning of the interview. So thank you very much for your time and to share your time with my channel.
Well, thank you very much, Hector. I look forward to speaking with you again.
Thank you.